For years, China's growing debts have worried investors. At the end of 2016, the total amount of credit in China amounted to nearly 270% of its GDP. In the US, that ratio is about 105%. So when Moody's downgraded China's credit rating, many investors said they'd seen it coming.
And given the amount of debt, not just by the government, but things like state-owned enterprises, people were always concerned that if they didn't reform this side of the economy and adjust, then it could run into problems further down the road, and this is something that the credit agency is clearly alluding to.
Moody's lowered China's rating by one notch from AA3 to A1. The agency said the downgrade reflects Moody's expectation that China's financial strength will erode somewhat over the coming years, with economy-wide debt continuing to rise as potential growth slows. China responded by saying Moody's has overestimated the difficulties faced by China's economy and underestimated the government's ability to deepen reforms. One of the most troubling aspects of China's debts is the growth of the so-called shadow banking sector. These are loosely regulated financial organizations that promise investors returns far in excess of traditional bank deposit rates. They're able to do this by lending at even higher interest rates to companies that are having trouble raising money from normal banks. In other words, the risk of these types of loans going bad is far higher than those at established banks, which are governed by tough rules.
Banks, trust, fund management firms, brokerages and insurers all have asset management operations. But because they have different regulators and are subject to different rules, there's been some chaos. Some capital has gone from the real economy to the virtual economy recently. We're working on joint regulation to set basic standards that every institution can follow.
But some analysts say the tougher the regulations get, the more tempting it becomes for people to venture into the murky and treacherous world of the shadow lenders.
Well, Azhar joins us on set now. Azhar, we'll get into the shadow lenders, which is always, it sounds like the beginning of a film, doesn't it? China has a trade surplus, generally speaking, so it makes plenty of money from all those things they make. Why does it have debt then?
Well, the analogy would be, you know, you're in a job, you're making money, but you go to the bank to raise a mortgage to buy a house. And that's essentially the difference between the two things there. So China has an ongoing trade surplus with the rest of the world, but it needs to finance its growing infrastructure and plenty of other projects that it wants to do. And it does that by essentially raising funds through its own banks.
So a lot of the debt is owed internally to its own banks. And
yes.
You say it has to do this. Does China sometimes spend money in order to keep the economy growing, in order to keep people employed?
There is a certain amount, there is a great amount of that, yes. Especially in the more further out rural provinces. A lot of the banks in those parts of China have a slightly riskier set of assets. I mean, we've talked about the zombie companies and the zombie banks in China. These are state-owned enterprises that are essentially being propped up by debt, by local banks. And they are essentially kind of supporting one another. If one falls over, the other one falls over.
Doesn't sound too healthy. I mean,
it's not.
Is it an artificial thing that they're inflating here and eventually will come back to bite them?
It could, but the thing is the central government has an incredible amount of financial reserves. And therein lies some of the moral hazard. A lot of these enterprises and commercial banks, smaller commercial banks, go on the principle or on the basis that eventually the People's Bank of China will step in if everything goes, if everything falls over. The lender of last resort is going to be there, but if such a crisis happens, it could result in an almighty domino effect.
Just really quickly
ripples
about
across the economy and beyond.
The shadow banking that you mentioned in your report there. So they make risky loans and therefore they can pay higher interest. However, if those loans turn bad, potentially people could lose their savings.
Absolutely. In fact, in certain instances, that's actually already happened. Back in 2012, there was a bank called Huajia Bank, which is partly owned by Deutsche Bank, as a matter of fact, in Shanghai. One of its employees went off and sold certain financial products that she wasn't authorized to sell, and dozens of people lost hundreds of thousands of US dollars because of these kinds of products based on mortgages and bonds and things like that. So it hasn't happened on a systemic basis yet, but the potential is always there.
Okay, Azhar, thank you so much for that.